righty, let's get this started. Thanks so much, everybody, for coming. Let's get right into it. So the title of my presentation today is The Bearish Bull Continued. I think I only have 10 slides, so might go a little short, but I'll try and fill out the whole 20 minutes. So the bearish bull, these are the three main things I'm going to talk about are the bearish bull that we're in for commodities, but mostly precious metals, and what is needed for precious metals to break out. And then lastly, I'm going to make a lot of historical comparisons to the gold stocks and that devastating bear market we had, and what those comparisons tell us for 2018 and maybe even 2019. So starting off, this chart it's an ETF it tracks the continuous commodity index, the CCI, which I prefer that to the CRB. The CRB and many of these commodity indices are so grossly overweighted in energy that they don't really tell the whole story of what's really going on. So the CCI tracks every commodity, but the weightings are more balanced, so things are more equal, whereas the CRB, I mean, if you look at the chart of the CRB, it basically just tracks oil. So this is a balanced look at commodities. And looking at this chart, we had that great rally in 2016, then a correction. Now commodities are starting to perform a little bit better. Of course, precious metals are struggling, but oil has recently broke out, I think, to a 2-year high. Industrial metals have been very strong. The ags are still kind of weak. So that explains why, we're still in this bottoming pattern after a devastating bear market. And looking at this chart, there's that resistance. I believe it's around 21, and you can see the red arrow. I mean, if commodities can get above that point, then the next target would be the higher red line that you see. And similarly for gold, that point is around 1550. For silver, that point's around 26. But until we see, for commodities as a whole, until we see commodities go above the 2016 high, then we can kind of remain in this bearish bull. And there you see the chart of gold. It's a little similar, although gold recently failed that resistance, whereas if you go back to the last chart, you can see the short-term trend in this is higher, whereas the very short-term trend for gold is lower. But technically speaking, gold really isn't in a true bull market until we take out the 2016 high. And I think we're probably going to go lower and test 1200 over the next couple months. But the bullish part of the bearish bull is that the bear market is over, the devastating bear market is over, and we're in a new bull cycle where we're seeing majors are investing in juniors. Juniors are able to raise money. We're seeing a huge amount of speculation, although it's extremely concentrated in just a couple of stocks. But those are all good signs that you're in a new bull cycle. And this chart we have, I'm comparing the TSX Venture, what we're seeing now in black. That was from the 2016 low, and how that compares to the 3 previous bull cycles. And, we're still kind of early. We're not quite in the middle. There's still a good amount of room to run, but we haven't taken out the highs from 2016 yet. Now, let's specifically, since I focus on gold, let's focus on that. And fundamentally speaking, gold is driven by declining real rates or negative real rates. And so what you need to see for that to happen is you need to see inflation rising faster than interest rates, specifically short-term rates. Or on the other hand, you can get negative real rates or falling real rates if the Fed funds rate is falling much faster than the rate of inflation. And I think as far as catalysts for gold, it's more likely that if we're going to have this breakout for gold in the next year, 18 months or so, it's going to be driven by higher inflation and not lower interest rates. And so in this chart, we have the 10-year yield at the top, and we have the CPI at the bottom. And both of these, I think we need to see them above 3% to drive gold to that breakout. Now, markets are always, they're a discounting mechanism, so they discount things in advance. So if these charts are going to go above 3%, gold is probably going to break out before that happens. But I want to talk a little bit more about bond yields, specifically long-term bond yields. And so the 10-year yield is kind of at an interesting point because it had this big rise in the second half of 2016, but you can see that it's held that big rise pretty well. I mean, it's corrected, but it's digesting that move. It's held most of the gains. And I think there's a threat over the next year or so that we could see a spike in long-term interest rates. And when we're looking at the fundamentals for gold as far as interest rates, what we want to see is we want to see long-term rates rising faster than short-term rates. The problem for gold right now is short-term rates and long-term rates are rising, so that's not good for gold. We need to see the 10-year yield just as a proxy. We need to see that rising much faster than the short-term rates or the Fed funds rate. You can use that. And so, I mean, it's around 2.4%. It has resistance at 2.6% and then 3%. So if we're going to see this spike in bond yields, I think that the move to 2.6, and then if we break above that, to the move to 3%, that's going to be bearish for gold because short-term rates are still rising by a little bit. We're going to get a hike next month. You know, if interest rates keep moving higher, we'll get another hike. But I think we need to see the 10-year break above 3%. So in other words, have a really big move higher to drive gold. Because if it breaks above 3%, you know, it could get to 4%. And we know that the Fed is going to stay behind the curve. They're not going to hike that fast. So if long-term rates are going to rise, and specifically the 10-year yield, we need to see it breaking above 3% to benefit gold. The move to 2.6, the break above 2.6, that's probably going to be bearish for gold, not bullish. And looking at the CPI, I mean, this comes back to real interest rates. We need to see inflation rising faster than interest rates. And inflation's been ticking up a little bit. But if we look at that chart, I mean, there's a trend line resistance around 3%. And if we could get above 3%, you know, that would be the highest since 2011. If we get to 4%, that would be the highest since 2007, 2008. So again, I'm just looking at, for these two metrics, 3% is a key level that needs to be breached to allow gold to, you know, make that breakout above 1350 to 1400. And we're looking at, I'm comparing the devastating bear market in the gold stocks to other devastating bear markets. And there's a pattern that all these markets follow. And after the bear market, you tend to have a very big initial rebound, but then after that, the market can consolidate for a year and a half or up to 2 years. And then once that is done with, then the market makes another leg higher. And that's exactly what's been going on with gold stocks. We had the big 6-month rally. It's now been about 1 year and 3 months since that point. I mean, depending on what index you look at, gold stocks have corrected about 40%. But the correction as far as time, I mean, if we look at these other markets, we can see that generally it's about a year and a half to 2 years before they begin their next leg up. So that would put us somewhere in the next 3, 4, 5 months as far as the next low point in the gold stocks. And from that low point, they would begin a move up that would be sustained. But focusing on, I want to focus on a few of these things. The gold stocks from 1980 to 1982, there's 2 indices I use. There's the S&P TSX, and then there's the Barron's Gold Mining Index. The Barron's Gold Mining Index, that's the one where the correction, if you look there towards the bottom right corner, that correction after the initial rebound went 60% for 3.5 years, whereas the TSX Gold Index, that correction only went for 1.9 years. So I don't think the 3.5 years, I mean, that's not a good comparison because that 80 to 82 bear market, that was only 2 years. I mean, we were in a multi-year bear market that lasted roughly 4.5 years. So I'm not worried about that data point, but I did want to leave that on there. But looking at, I mean, the housing I've made this comparison in my past updates, but housing is an interesting comparison because that bear market lasted 3.5 years. It was 81%. The rebound was 137%, so nearly what the gold stocks did. And then 42% correction, year and a half long correction and consolidation. Then the next leg up began. So this is just really interesting to me, studying the history and also looking at gold and platinum there at the bottom. And I could have also added silver, but we'll get to that. Those were more double bottoms, whereas and a double bottom is where you get a big rally and then the market comes all the way back down to retest that low. Looking at the action in gold stocks, I don't think that's going to happen. So the comparisons to the comparison to the other markets on there makes more sense. But what I wanted to note about gold and platinum in those double bottoms in the early to mid 80s is after their initial rebound, the time from that point down to when the double bottom happened, that was 2 years. So 2 years from the summer 2016 peak would put the low summer 2018. So I wanted to mention that. And here is obviously silver's longest bear markets. And I've talked about this before, but silver, these really long bear markets, 5 or 6 years long, and we're measuring in terms of time, because obviously the price lows occurred earlier. But when you measure something in terms of time, you're really measuring to the point when the market really starts to move up and continue to move up and make higher highs in true bull market form. And we can see that these other three bear markets, the rallies, when they started to go up and kept going up, you had 94% after the early 80s and mid 80s. The one from 96 to 2001, 92%, and then 87 to 93, then plus 64%. All these three rallies happened in 12 to 13 months. So, and that would put, even if silver came back down, like let's say it came back down to 14 or 14 and a half, a 65% move, you're still getting to the mid 20s. So silver has strong resistance at $26 to $27. So, whenever silver starts to move up, that would be, just looking at the chart, that would be my target. But then looking at history, that makes a lot of sense based on these historical rebounds. And this is one that I added, just looking at, because I was thinking to myself, okay, this pattern of you have a mega bear market, and it lasts several years, over 80% decline. Then you have a big rebound, then you consolidate for a little while, then you go up after that. I was thinking, Thailand, that was a really bad bear market. I wonder how that looks. Well, we can see here, it's a somewhat similar pattern to the gold stocks. This market was down, I think, 87, 88%. The bear market lasted more than 4.5 years. And the first rebound, 142%, didn't last much more than 6 months. Then it came back down. It actually bottomed about 1.4 years after that initial rebound. But then it kind of did nothing for another year, and it was another year until the market really took off. But then, from that point, nearly 2.5 years after the initial rebound peak, it went up 180% over the next 2 years, and then it kept rising even steadily after that. So looking at that, where would that put gold stocks? That would tell us that if gold stocks are following this, there would obviously be weakness well into 2018. But end of next year, based on this, would be when the gold stocks start to move up again. So it's just fascinating to me how these multi-year, you're looking at 3, 4, 5-year bear markets that are down over 80%. Just the pattern that is followed after that, after that bottom, it's just so fascinating to me. And gold stocks appear to be following the same pattern. And it's just a question of when the next lows are going to be, and when the next move up will start. And getting into the gold stocks, we can see, I mean, it's been about a year and 3 months since that first rebound peak. And looking at where we are here and now, there's two negatives with precious metals. The last time I was here in September, I talked about the negative divergence between precious metals and the dollar. The dollar made a new low relative to 2016. Its low point this year was lower than the 2016 low, yet precious metals did not confirm that low. Normally, you would expect precious metals, or at least gold, to make a higher high if the dollar is going to make a lower low. So in September, I mentioned that as a potential negative. The other negative divergence is just go back to early this year, and you can see that gold has been steadily rising, making higher highs, just kind of in a short-term context. Whereas if we look at the gold stocks, they have not been making higher highs. They peaked at the beginning of the year, whereas gold's peak for the year was likely in September. So those are two negatives that concern me. And the gold stocks, the last couple of weeks, I mean, they've been really oversold, but the rally has just been really, really weak. And so they look like they're getting ready to break down again. So I think the trend over the next couple months is looking pretty bearish. But we'll probably get some kind of a low after the Fed meeting. I mean, if you go back over the last year or so, the lows after the Fed meeting, they weren't like immediately after the Fed meeting. They tended to be maybe 2 or 3 weeks after the meeting. So maybe the next low will be in January, and maybe we'll rally for a little bit and come back down, and make a much more important low around the middle of the year. So summing things up, there's 3 things you should remember. Okay, so based on this history, I mean, I put gold low, but I really should say gold stocks low. So the next low, and I'm talking about a low as far as when is the market from that point going to go up, 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 and just sustain it? Because it's possible that we get a low in price in January and we rally for a month or two, but then the market comes all the way back down to that low second quarter or third quarter. So the more significant low is not the first low, it's the later low. So I just want to clarify that. But based on this history, we could see the gold stocks make an important low sometime middle of next year. I mean, based on these historical comparisons, it could be in the second quarter, it could be in the third quarter. And then fundamentally speaking, gold, we need to see a sustained rise in inflation. And at the same time, sustained rise in long-term bond yields. So we talked about the 10-year. It looks like it's going to test 2.60. If it breaks above 2.60, then it could test 3%. So I think the break above 3%, that is the point when it would be bullish for gold rather than bearish. Because as I noted, if short-term rates and long-term rates are rising together, that's negative for gold until long-term rates start to rise faster, and that's not happening right now. And so finally, I mean, those are the negatives right now, but based on the history that I've showed you, the second half of next year in 2019 are setting up to be very, very bullish. I mean, the gold stocks are following this historical pattern. And obviously, we don't know like exactly when the next low might be. When are they going to take off? I mean, this history tells us, it could be middle of next year, it could be late next year. But based on everything I'm looking at, I think middle of next year into 2019, that is going to be the point when things really start to take off again, like they did in the first half of 2016. So where we are here and now, near-term trend looks negative, raise cash, but at the same time, get ready to be buying things in the first half of next year. And that's all. And next up.